Look at this divergence on your screen. Bitcoin is hovering around $65,000, a roughly 50% drawdown from its October peak. Meanwhile, the S&P 500 remains elevated near all-time highs. So in my 15 years on the trading desk, I have rarely seen a divergence this extreme. One asset is pricing a massive evaporation of global liquidity, and the other is relying on a passive momentum. Today we are looking at the raw data to understand why the financial plumbing suggests equities may be highly vulnerable in the weeks ahead. To understand why crypto is bleeding while stocks float, we have to look at the Fed's balance sheet and specifically the Reverse Repo facility or the RRP. Stocks are blindly following a passive algorithms. Bitcoin is watching institutional liquidity. For 2 years, the RRP acted as a liquidity buffer. It shielded markets from the Fed's tightening, but in October that buffer effectively hit zero. That same week, Bitcoin peaked at $126,000. Why? Because Bitcoin has no share buybacks to hide behind. It is a pure gouge of dollar liquidity. When the cash buffer dried up, Bitcoin repriced immediately. The S&P 500 has lagged because passive 401k flows do not watch the Fed's plumbing. They just buy. But blind buying does not fix a stressed banking system, and we just got proof that the system is stressed. This week, the Fed quietly pumped $18.5 billion into the banking system through overnight repos. So on Twitter, people are calling this a massive bailout, but it's not. In Fed terms, 18 billion is a rounding error. But that is not the point. The point is the friction. Why is the Fed forced to provide emergency interbank liquidity when the S&P 500 is at all-time highs? Because the plumbing is seizing up. Commercial banks are hoarding cash and the well is running dry. And that friction is about to collide with a massive liquidity drain. We are entering corporate tax season. Starting in March, billions of dollars will leave commercial banks to pay the US Treasury. That money goes into the Treasury General Account, or the TGA. When the TGA rises, market liquidity falls. It is a vacuum. In previous years, we had the RRP buffer to offset this drain. Today we do not. And the drain is exponentially larger this year. The US debt spiral means we are now spending over $1 trillion annually just on interest payments alone. To fund that, the Treasury must issue record debt, sucking even more capital out of the private sector. I am about to show you the Tokyo Timebomb chart that complicates everything for the Federal Reserve. But first, if you find this level of data-driven analysis valuable, hit the subscribe button. We focus on institutional plumbing, not retail hype. Now, let's look at how liquidity crises actually unfold. If this treasury vacuum triggers a broader market event, investors need to understand cross-asset correlation. During a severe liquidity draw, institutions do not just sell their users, they experience margin calls. And when you get a margin call, you sell what you can, not what you want. You sell your winners to raise dollars. This is why we historically see assets like gold and metals and mega cap tech sell off simultaneously during the initial shock of liquidity event. Dollars become scarce and everything correlates to one. Complicating all of this is the situation in Japan. Japanese 10-year yields are currently trading above 2.1%, and Japan is the largest foreign buyer of US debt. But with their own yields rising sharply, Japanese institutions are economically incentivized to dump US treasuries and bring capital home. This creates a trap for the Federal Reserve. The US Treasury is issuing record debt, just as their biggest customer becomes their biggest seller. If the Fed cuts rates right now to support the US stock market, they collapse the yield spread, which accelerates Japan's selling of US bonds. If they hold rates high, the domestic liquidity vacuum crushes US equities. But there is one theoretical escape hatch. If the Bank of Japan intervenes and actively forces their own yields back down, restarting yield curve control, the spread widens. This would give the Federal Reserve the breathing room to cut rates without triggering a doom whoop in the bond market. But here is the geopolitical checkmate. The Bank of Japan likely cannot do this because of China. Japan and China are locked in a ruthless export war. If the Bank of Japan restarts the money printer to cap yields, they would sacrifice their currency. The yen would collapse, and a cheap yen makes Japanese exports highly competitive. But Beijing will not just sit back and watch Japan steal their global market share. If the yen collapses, China would likely be forced to devalue the Chinese yuan to compete. And if China devalues the yuan, they export a massive deflationary shockwave to the entire planet, igniting a brutal currency war. So the Bank of Japan is paralyzed. They cannot cap yields without wrecking the yen and provoking China, which means they must let yields rise, which means they must sell US treasuries, which leaves the Federal Reserve trapped with no one left to buy their debt. So to summarize, the RRP is empty, the overnight repo market is flashing warning signs, and the March tax drain is imminent. The bear case risk to this thesis is that corporate buybacks and passive flows remain strong enough to absorb the liquidity drain, kicking the can further down the road. But if Bitcoin fails to hold support around $65,000, it may signal that the liquidity vacuum is overpowering those flows. So I want to hear from you. Are you positioning defensively, or do you believe the market can power through this liquidity drain? Let me know in the comments. Subscribe for more institutional grade analysis. Trade the data. I will see you in the next week.